Hello, everybody. My name is Amy Madden,
And I am Susan Faber with the guest on today,
and I'm coming to you today to talk about.
the living benefits of life insurance. Hi, Susan. How are you today?
Doing well. Thanks for having me again, Amy. How are you?
Absolutely. I'm great. So I'm excited to get into this. Most people think that life insurance is all about death benefits. You have to die in order to be able to receive any benefits from it. But the reality of it is that there's many living benefits that you can get from life insurance. So I'm going to start with saying what type of life insurance policies there are. There's three, virtually three. There's some other ones, but there's term life insurance, there is whole life, and there's indexed universal life, and they all work very differently. I'm not going to get into the real specifics of each policy, but what we do want to do is dive into how you can receive benefits while you're alive versus when you die.
Yeah, and I think that's really something I don't know a lot about, so I'm sure I'll be asking you lots of questions, Amy, because at least from my understanding, I've just always thought of life insurance as something that you need as a legacy to pass on to your family, to take care of funeral costs and what happens when you're gone. So I don't really have not heard that much about actually using a policy while you're still alive and using it as a way to benefit you. But I know that's something that the wealthy do. Like the millionaires and billionaires out there all seem to really utilize this tool, but I don't know how.
Yep, you're absolutely right, and a lot of business owners too. So let's start with the easiest one, term insurance. Typically, that is a policy that you purchase and you pay the premiums for 5, 10, 20, 30 years. And once that time period ends, the policy really goes away because it's way too expensive to keep it. And in those type of policies, they don't have any cash value in them. So really that is structured primarily for a death benefit. But if you have that policy and say you were diagnosed with a critical illness, so you have cancer or some kind of heart disease or something that is going to be very costly, they do have riders on these policies for critical illness, meaning that if you get sick, you can take 50% plus of the death benefit. They'll send you a check for it. They'll send you a check. And what you can do is you can use that to pay bills while you're sick, pay hospital expenses, any kind of equipment you need, replace income if you can't work, whatever you need, they'll give you that, and it's just in a check and you spend it the way you need it to. If you were terminally ill, meaning that you're going to die in the next couple of years, they will give you up to 80% of the value of the death benefit for you to spend while you're alive. It's really hard for people to understand that 80% of the problems that people have financially is from a disability. And that means that you just don't have that money coming into your house to be able to pay for things while you're sick. So these type of riders, which are really built into the policy, can help you. Sometimes they're built in, sometimes you have to add them, but there's no cost to them. So these type of riders can really help somebody that runs into some health issues, and they can receive the money while they're alive.
So Amy, knowing that term insurance, you were saying it can be a little too expensive to actually keep the policy. So a lot of times it doesn't last longer than, the determined term when you get the policy. So what type of person would be interested in that? Is it someone who knows they're sick or has that type of illness in their family? Like what type of person should be looking into this sort of thing?
Into the term insurance or into the riders?
Into the term insurance. I'm kind of interested to know why people would go for that one.
So many people buy term insurance because it's much less expensive than a permanent policy. So term insurance kind of came in, whole life's been around forever. Term life insurance was probably the second one. Honestly, it's less expensive because probably only maybe 10% of claims are ever paid on that. So this is where you see big insurance companies making money and building sky rises because term insurance is a very profitable business. Most people will not ever use the benefit on a term insurance policy. People purchase it because they need a lot of insurance, in particularly when they have children.
Oh, okay.
So when you have young children, you want to protect your income in the event that you pass away. Group insurance will give you 1 year or 2 years, and people think that's great, but that means you only last for 1 or 2 years with the same income.
Mm.
With term insurance, they would probably purchase more like 10 to 15 times their income so that there's money there for the family for while the children are growing and even for the spouse maybe in retirement. So those type of policies are usually more larger. So a million, 2 million. I mean, even as low as 100,000, but they'll buy a bulk of that, and they may coordinate it with one of the other type of policies, but that's a big bulk until the children, kind of through college and everything. And then
Okay, that makes more sense to me, especially with, chronic or terminal illness riders, because, if you have small children, that's the same type of concern as if you have some type of illness like that. So,
right.
okay.
And many people think that, okay, you can sell, you can pay off the mortgage so that they can live in the house for free, or they can invest that money. There's different things you can do if it actually pays out. But like I said, term insurance, most people do not pass away and take a payout on term insurance. It happens, but majority, 90%, don't ever pass away during that time period that they have it.
Okay. And term insurance, is that one of the use it or lose it type of policies?
It is. Yep.
Okay. Thank you.
Perfect example.
Thank you.
You're welcome. And then a lot of people don't carry that into old age. So it's more typically we see in younger generations up to like age 70, because then it does start to get very expensive. So you might want to look at other areas after that.
Okay. So is that where something like whole life might come into play for someone who's looking for something more long term?
Yes, exactly. Yep. And so with that being said, let's talk about whole life insurance.
Okay, perfect.
So that's going to bring us into how whole life insurance works. So whole life, again, is you purchase a policy. It has a death benefit. That death benefit grows with years that you have the policy for. Internally, and the way it grows is internally, you receive dividends. Also, a portion of the premium that you put in there goes into a cash value column. That cash value can be used at any time for any reason. And you can use it tax-free. So let's talk about whole life insurance. You purchase it today, 1, 2, 3, 4, 5 years from now, not a huge amount of cash value. After like 15 years, there's more money going into the policy than you're paying in premiums. And I know this for a fact because I have it on myself.
Okay, yeah.
I've had it for a long time. So internally, that cash value can be used for many things. You can also have a critical illness rider on there. You can have a chronic illness, which typically works as like a long-term care policy. It's not a long-term care policy, but it works just like it. You will lose 2 activities of daily living, and you can usually use up to about 80% of the death benefit in most policies for long-term care expenses. So you need long-term care, you don't have a long-term care policy, or you do have a long-term care policy and it's just not covering everything. You want to look, make sure it's like an indemnity policy, so they just pay you the money. You need money, they just send you a check and you spend it how you need it. Equipment for the house, stairs. You can't do stairs anymore, so they put a chair rail out. You might need a handicap ramp. Bathrooms might need to be done. You can use that money for all of that. If you're healthy and still alive, you can use the cash inside these policies, tax-free income to you in retirement or at any point in time in your life. So when I was young, I've had whole life policies for a long time. My first car I bought, it was, a used car. Interest rates were really high. So what I did was I went and took a loan out of my whole life policy, paid for the car, and then I paid myself back into my whole life policy at a much less interest rate. Now, I paid that back because I was younger, but these policies are designed that if you're going to take it as retirement income, you never pay the money back.
So is there a difference between using the cash value and taking a loan on the policy, or does it just depend on whether you want to pay it back or not?
No, so usually what happens is you can use up to cost basis. So it's just kind of, it's not an investment, but the internal taxation of it works like that. So you could take up to the cost basis. There would be no taxation. Anything over and above that would be taxed. If you take it as a loan, it is not taxed. And these policies are built for these loans, and many are built so that you can't take too much money out of it so that they collapse, because if they collapse, then you have to pay the tax back. So you want to make sure that that policy stays in place until you pass, but you work with the insurance company and they can set you up with an income. The loan's there, you never pay it back, but it doesn't exceed the cash value that you have in the policy.
Okay, got it. And if you were to just take a loan and want to pay back the policy, pay yourself back, what do the interest rates look like for that? Because I know interest rates change a lot and they seem really high right now.
Yeah, so I would say on average, and again, it changes, but they're usually like 2% lower than what you would get in the market. So say you're paying 6% for a mortgage, it'd probably be 4%.
Okay, interesting.
One of the interesting facts is when the collapse happened in 2008 with the banking industry and they weren't giving loans, the life insurance policies were actually what kept the economy going, because businesses went to their life insurance policies that they had on key people or on themselves, and they borrowed the money that they needed to keep going until the crisis was over.
Oh, wow.
Yeah.
Oh my goodness.
The even stranger part is banks have a ton of key man insurance policies on executives that are no longer even there. So they keep these policies and they're going to get paid out when the person passes away, but they have a ton of these policies on their books.
Okay. So is this something that the average person could get, or do you have to be super healthy to get a whole life policy?
No, so you want to be able, because if you are too rated, the rating really takes away from the cash value. So you want to be a standard or better, which most people will fall into nowadays. There will be some people that will get rated, and you'd have to look at whether or not that's beneficial for them at that point. But no, anybody that's fairly healthy.
We talked in our last episode about how expensive long-term care can be and how difficult it is to get the income you need to take care of yourself or others when they're in long-term care, not receiving a normal income from salary. And even if that's something that you can get while you're healthy, and then hopefully you never have to use it for long-term care, but a lot of people need it more and more than ever. So even if you get it when you're healthy and can use a policy like that for those long-term care costs, that's pretty amazing, because it's really hard to kind of come up with that income if you don't have a plan.
Yes, and the other thing is people really like these type of policies for that, because it is, again, one of those, it doesn't become a use it or lose it. So with the other long-term care policies, nothing's guaranteed. The premiums aren't guaranteed. So the premiums go up and you might have to change the benefits around because you can't afford the premiums anymore. Here, it's pretty simple. You have your life insurance policy. If you die, your beneficiaries receive the benefit tax-free. If you live and need long-term care, you have the death benefit available to you to use during your lifetime. Or if you decide you wanted to cancel the policy and get your money back, there's the cash value in the policy. Most people don't cancel their whole life insurance policies. I've been doing this since 1998 and I haven't seen one person cancel it.
If you were to cancel it, would you just get your initial premium or whatever you've been paying in premiums, or would you just get the accumulated cash value?
It depends. So every year you have the policy, the cash value grows. So if you cancel it in the second year, you're really not going to get your premium back. So each year that cash value is growing. So you'd have to look at, all you're going to get is back your cash value. Is it more or less than what you paid into the policy? It would just depend.
Okay, and my last question for this one, I think, is if you had the policy and you die, is it something that can go to your beneficiary as a whole life policy, or is it then cashed out and given to your beneficiaries?
It's cashed out. It's a death benefit, and it goes to your beneficiaries tax-free as the death benefit.
Okay.
So
Okay.
say you had $1 million death benefit and you hadn't used any part of it, then your beneficiaries would receive $1 million tax-free.
And I think that's pretty crucial too, because a lot of times we see people with these, pretty nice estates, property, savings, different things like that, that's passed on and then is taxed. So having a vehicle where that's tax-free, I mean, that could be a huge impact, especially for $1 million policy.
Right. So if you're looking at trying to move part of your estate to your beneficiaries tax-free, many people always think about Roth conversions, but life insurance is another awesome way of giving to your beneficiaries, your spouse, of course, but your children, tax-free money. It's huge. Which brings me to another thing. Many grandparents will purchase life insurance on their grandchildren when they're born. Now, there is a key factor here. If the child has $1 million death benefit, so we've seen many grandparents do $10,000 a year for 10 years. So it's paid up in 10 years and there's no more premiums owed. But that gives the child like $1 million worth of a death benefit. Well, parents have to make sure that they have 2 times of whatever the children have, because they'll never overinsure a child. They'll never allow a child to have more life insurance death benefit on them than the parents. The parents have to have double in most cases. And the reason is sad, but they don't want to see children being hurt.
Oh, right. Wow, yeah.
So, I mean, it's a sad reason, but that's when they'll never allow children to have that much death benefit unless the parents have it.
So if you have 2 parents, each has a $1 million policy, could the child then have a $1 million policy, or does each parent have to have 2
One
million?
parent has to have at least double.
Okay.
And it can be through anything. It can be through group insurance, term insurance, whatever. So you can do it pretty inexpensively. Many times the grandparents will purchase that. But here's the beauty of these policies. So they pay for 10 years and the policy's paid up. And say they do it when the child's like 1 year old. By the time the children go to college, it can fund their college education. They loan the money out. They have their college education paid for. They don't pay it back. And then let's say 5 years later, or, whatever, 10 years later now, maybe, whenever people get married, you can take a loan out for that and pay for your wedding. And then you don't take anything out again until you retire. And these things have turned into cash cows. And then they get a retirement income. I mean, I've seen as high as, over 200,000 for 20 years when they retire.
Wow.
So if you look at that benefit, and then there's still a death benefit to leave to their children. So
Exactly.
grandparents look at it as a multi-generational gift. The grandchild's getting the cash value in the policy, and the great-grandchildren are getting the death benefit.
Oh, absolutely. And what a gift it is. I mean, so many people, including myself, have student loans that we'll have for a long time. I feel like that's just kind of a product of the generation these days. Everyone has student loans. So not only having the gift of having your college paid for, but also the gift of not having debt. So it's kind of double. So it's the relief of not having to worry about paying for college, but then the relief of not having debt for 10 plus years after you get out.
Right. And then you have some grandparents that are doing 529 plans, which are great. But what happens if they don't go to school? What happens if they don't get a further education? It creates a problem where here they're giving the gift if they decide they don't go to college or they're doing a trade or something. They still have all that cash still growing in them, in those policies for whatever they want to do later on.
So I might have to double check this, but I've been seeing that 529 plans are changing so that if the kid does not go to school, they can then roll that money over into a 401k. But I don't think a 401k you would have a lot of access to until you retire, right?
That is true. I'd have to look at that. I haven't seen that one. Usually, like if a parent has it, they could roll it into theirs. Like it could be kind of like an IRA for them. I don't know about rolling it into for the children, but I'd have to look at that.
Either way, I don't think it would be as usable
Right. It's not as accessible, right? And depending on how old the parents are too, it's not accessible for them if they had children younger until they're 59 and a half.
Okay,
I mean, it's
exactly.
still better, but it's still something.
Yeah, exactly.
And then there's universal life. And probably the most popular one right now is an index universal life. And I do like these policies for younger people. It is definitely less expensive than a whole life policy. There's just a couple of things that you have to watch out for index universal life. Insurance companies, so it's you purchase a life insurance policy, the cash value goes into indexes. And you can pick your index. Let's just use an S&P index, for example. Well, they put a cap on that, 9%, 10%, and they can change that cap every year. So if that index does 20, you get your 10%. If it does
Okay.
5, you get 5, but you're never going to get over whatever they set each year as a cap. This policy also has mortality charges. So as you get older, those mortality charges can get, bigger. So it might not be as much cash value in those available for, taking money out. It just really depends.
So what is a mortality charge?
There are actuaries that are in there that say, okay, you're this age, the chances of you being super healthy is this, so we're going to charge you very little. You're now 70, chances are you might get something, chances of dying are a little bit closer, so we're going to charge you more fees for that. And then you get into 80 and they charge more fees. So this one is a great policy. It just has variables. So it's mortality charges. Some companies charge very low mortality charges. Some charge very high ones. So you just want to look at those. And then it's dependent on the market, which may be a good thing, or it may not be a good thing, just depending on how the market goes. And then you also have caps. And there are some other fees and expenses built in there. So you just kind of want to look at the companies and the fees and expenses. And those are just the bigger things to just be aware of. But it works just like a whole life policy. The cash value in there, you can take out tax-free. You can take a loan on it. You can use 80% of the death benefit for long-term care expenses. And again, if you wanted to cancel a policy, you would receive the cash back that's in the policy. So you can get your money back.
So Amy, something we talk about kind of a lot at F3E is how your investments change as you age. So when you're younger, you can be more aggressive, older, more conservative. So for those index universal life policies, is that an index you can change throughout the years as you become more, conservative and older?
Yeah, great question. So each policy has probably 10 indexes in there. And you can have many indexes. Probably, again, one of the most popular is the S&P. But you can have the S&P, you could have a Schiller index. You could split the money in between however many indexes you want, and you can change those indexes each year. So you can see how the policy is performing. You can look at what's going on in the world and the market, and you can change those indexes every year.
There's definitely something to be said for a policy like that where you have potential maybe for more growth, but I don't know, to me it seems a little scary that it's variable. They can change the terms and change the fees. What's your experience with people with this type of policy? Have they been kind of satisfied or expecting the fees that they get, or is it a shock to them?
So no, they don't really receive the fees and they never really see them. They're built into the policy. So they just see their returns.
Okay.
So it's not like they're going to receive a check, a bill saying you owe this. It's just all built into the policy and it's built into the returns that you see. So most people aren't even really aware of those. It would be good for their financial advisor to talk to them about it, and they should ask questions about that, just so that the advisor can look at the fee structure of each company. Like I said, some are very low, some are high. So you just have to be aware of those and which companies they are. Your question on why would somebody do an index versus a whole life versus a term? If you look at insurance policies, term is the least expensive. Whole life is the most expensive.
Okay.
Indexed universal life is in the middle, and it gives as many benefits pretty much as a whole life policy does. It just has a little bit more moving parts that you just need to be aware of. And people love their indexed universal lives. I mean, here's the thing. Each type of policy is structured. Term is just term. Whole life is structured on interest rates. So when the interest rates were really low for many years, whole life policies were still doing better than you would have gotten for interest rates outside, far better, but they weren't keeping up. And the market was doing really well. So then indexed universal life policies actually did better in those years of down interest rates. So you have to kind of look at, what is the dividend run on whole life? Because some companies are small, some are big. So you have your mutual companies that are out there, Mass Mutual, New York Life, Northwestern Mutual, Guardian, and they all run a little bit differently. So you just want to work with a competent financial advisor that can educate you on all these, and then how each policy works and looks like, because loans from these policies are all very different too. So although they're beautiful things, you just want to look at how each company structures their loans and their dividends. Do some reduce the dividends if you have a loan? Do some not? So there are just different things. But the biggest thing is I want everyone to realize is that when you purchase a life insurance policy, it's not just a death benefit. There's many ways you can use it for your living benefits. And I would just recommend working with somebody that has an education on the companies out there and how they work, just to make sure you get the best policy for you.
I think a lot of times when people come to us for financial questions or financial plans, they want to know what to do when the what ifs happen. What to do if your water heater goes out, you need a new roof, you need a new car. So this is another tool maybe to think about as a plan for your what ifs.
Right. Because as you're looking at your financial picture, there is what you have for retirement income or brokerage income or savings accounts, your home. And this fits into that picture for many people for either retirement income, legacy planning, long-term care, chronic illness. It can play many different roles versus just being there when you pass away.
Well, thank you so much, Amy, for running through those three things. I know these are topics that can be complex and it's different for everybody to see if it works into your specific financial situation and your lifestyle. But we really appreciate this education and definitely answered a lot of my questions. Hopefully you guys got some questions answered as well. But thank you so much, Amy.
You're so welcome. And thank you for joining me. And the big thing is there's not one thing that fits all for everyone.
Right.
So everything's very different, and just work with people who you know and trust that can help guide you through that. Thank you so much, Susan, for joining me. It's been a pleasure.
Absolutely. Thank you, Amy.
Take care.
Bye.